So in this video, we're going to discuss the different kinds of intangible assets that a company might have. So the first one we'll discuss is that of goodwill. So goodwill basically represents an amount that a company has paid to acquire certain favorable intangible attributes as part of acquiring another company. So positive attributes often included in goodwill would be things like a favorable reputation, positive market share, having a positive advertising image, having a good reputation for really loyal employees or really high quality employees, having really good management, and having operating efficiencies or something that they just basically do really well. So goodwill, which we won't get into too much detail, but goodwill is essentially the amount that a company pays for another company over and above the fair value of its net identifiable assets. So dollar-wise, if we're talking about the dollar amount of goodwill, it's going to be the total amount paid for a business minus the fair value of that company that was purchased, of the fair value of that company's net assets, its net identifiable assets. So whatever amount a company is willing to pay for another company over and above its net assets, that would represent goodwill. Which why would someone want to pay more for a company than it's just its net assets? Well, it would be because of the company's, for example, its good reputation or its good image or its superior management, stuff like that. Whatever it might be that causes a company to have favorable attributes that are intangible. So when a company is purchased, not only will that company's net assets also go on the books, but we would also record goodwill on the books related to that purchase. Now, patents. A patent, almost all of us would be familiar with a patent. A patent is an exclusive right granted by the federal government for manufacture, use, and sale of a particular product. So it's the right to basically manufacture something. So the purpose of a patent is to encourage people to invent new things and to innovate. So when a company acquires a patent by purchasing it from an inventor or other holder, the purchase price of that patent is recorded as an intangible asset on the books, titled patents. So it'll actually go on the books as an asset. And patents are usually granted for a period of 20 years. So when you amortize the cost of a patent, it shouldn't exceed 20 years. Now, if a company estimates that a patent won't be useful for the full 20, then the amortization estimate would be less than 20 years. So let's, for example, say that a patent is purchased for $100,000 after 5 years of its legal life has expired. So if the patent is 5 years old, then it would have 15 years left of its legal life. So what would be the entry to record annual depreciation on that patent after we now purchased it and we know it's 5 years old? Well, we would divide that $100,000 cost of the patent by the remaining legal life of 15 years. So if we take that $100,000 and divide it by 15-year legal life, I missed a zero there, 100,000 divided by 15-year legal life, so that's 6,667. So that would be the amortization expense that would be recorded every year. So we would, entry-wise, you would have to end up debiting amortization expense for 6,667, and you would directly credit patent. So this is a bit different. There is no accumulated amortization account here. So you would directly credit the patent account. So that's what it would look like in general to record amortization expense. Now, keep in mind we use straight line for amortization purposes. Now, what about a trademark or a brand name? So we know Coca-Cola is one of the most famous trademarks out there, and it's something that is recognizable, that everyone knows what it refers to. So a trademark is a name, a symbol, or a design that identifies a company or a product or a group of products and distinguishes it from others. So a permanent exclusive right to use a trademark or a brand name can be obtained by registering it with the federal government. So that's why sometimes if you'll see a brand name, it has a little trademark symbol next to it because it has been registered with the federal government, and no one else is then allowed to use that name to operate a business and to generate revenue. So the costs of developing a trademark. So, because it will cost a company money to build up to that, but the cost of developing a trademark or a brand name, it'll consist of things like advertising campaigns and all of those expenses that you incur to develop a trademark are going to be expensed when they are incurred. So, expensed as incurred. So the costs involved with developing a trademark. So the important thing is here, costs involved with developing a trademark. So the cost of a trademark, of developing one, is expensed, not capitalized. So we don't amortize the cost of a trademark that is internally developed. However, if you end up purchasing a trademark or a brand name, the cost of that can be rather material. So when that happens, when you don't internally develop a trademark, but you purchase one, in that case, that cost won't be expensed. In that case, that cost would be capitalized, and you will see the word trademark as an asset. So there would be a trademark account as an asset on the books, as an intangible asset. That cost would be capitalized, and its cost would be amortized over its useful life if you end up purchasing a trademark. So the cost would then be capitalized and it would be recorded as an asset on the books and then amortized over its useful life. But if you internally develop a trademark like Coca-Cola did, you won't see that as an asset on the books, but the expenses incurred with developing and maintaining that trademark are simply just expensed in the period in which they are incurred. Now, what about a franchise? We're all familiar with franchises. Things like a McDonald's franchise or Starbucks franchise exist, which is a franchise is basically a right that is granted by a company or a governmental unit to conduct a certain kind of business under a certain kind of name within a certain area. So, for example, a McDonald's franchise would allow you to open up a McDonald's and operate under that name and operate that kind of business within a specific space. But no one can just go and open up a McDonald's without obtaining a franchise, right? You'd need that legal permission. So the cost of franchises can be really substantial and material. They can be very expensive. However, if the cost of a franchise is really small, if it's immaterial, the cost of that franchise can just be expensed out immediately. However, if the cost of a franchise is considered material or substantial enough, the cost of the franchise would be capitalized, meaning there would be a franchise account created where the cost of obtaining that franchise would be added to that franchise account, and its cost would be amortized to expense over its useful life. So when the cost is material, once again, you will add it to a franchise account, and then the amortization of the cost of that franchise will be based on the life of the franchise, which usually the franchise agreement would detail how long you are allowed to operate that franchise. But it's still important to note that you shouldn't to determine that amortization expense, the useful life shouldn't be longer than how long you expect to generate revenue from that asset. So if the legal amount of time that you're allowed to operate the franchise is longer than the amount of time you actually expect to use it, you should use the smaller amount. So if you only intend to benefit from the franchise or use the franchise for a fraction of the time allowed, you should use that smaller amount when it comes to estimating that amortization expense. All right, what about copyrights? So a copyright is an exclusive right granted by the federal government to protect the production and the sale of literary or artistic materials for the life of the creator plus 70 years. So this one also has a specific legal definition like patents. So the life of the creator plus 70 years. So that's how long literary or artistic work is protected under copyright. So the cost of obtaining a copyright, it can be minor. So if it's a small cost of a copyright, if the cost is small, you would just expense it in the period in which you incurred that cost. However, if the cost of the copyright is material and substantial, you would actually create a copyright account, which would refer to an intangible asset on the books, and you would add the cost of that copyright to the asset account titled copyright, and that would be amortized over its useful life as well. Because usually the cost of a copyright can be quite material that would necessitate it actually being capitalized. So if it's a material amount, you would capitalize that cost and it would be amortized over its useful life. And lastly, research and development costs. So this is not quite an intangible asset, but at one point, GAAP allowed companies to capitalize research and development costs, which caused R&D to show up as an asset on the books. However, the rules have since changed. Now, research and development, some companies spend billions on research and development. Think of pharmaceutical companies, for example. Billions are spent every year on research and development of new products. And the total amount of research and development can account for a large part of a company's total expenses. Now, we said before, GAAP had allowed R&D costs to be capitalized, which means you add the cost of R&D to an asset account called research and development. But the rules have changed, and FASB decided that the general rule for research and development is that all research and development costs are expensed as they are incurred. So if you spend $2 billion in year one on research and development, you don't get to put that in an asset account and amortize it away. Instead, you're going to have to show an expense of $2 billion on that income statement in that year. So this rule, having now changed to having to expense R&D costs, really has a large effect on companies' bottom lines, because instead of those expenditures being tucked away as an asset and being amortized to expense little by little, instead, now we're having to expense the whole amount as it's incurred every year, which shows up as a huge expense on the income statement. So the rule has now changed. It's no longer considered to be part of the intangible assets, because these costs are not capitalized, but they're expensed immediately in the period in which they are incurred.